In recent years, the banking system in the United States has shown signs of fragility. In 2025, bank reserves, which are the funds that banks hold in deposits at the central bank, dropped to their lowest level in 4 years, totaling only $2.8 trillion. This is the lowest value recorded since 2021, and it signals a potential liquidity crisis that could profoundly impact the US economy and even global economies. To understand the risks of this situation, we must first understand the vital role that bank reserves play in the financial system. What is happening? A liquidity shortage, as the name suggests, occurs when there is a lack of money available in the market. In simple terms, the lack of bank reserves means that banks have fewer resources to cover their daily obligations, such as customer withdrawals, and more importantly, to continue providing credit to the economy. Credit, in turn, is essential for economic growth because it allows consumers to buy homes, cars, and businesses to invest in their operations. When reserves fall, access to credit becomes more restricted, which can lead to a slowdown in consumption and investment. In recent months, many analysts have been warning that if the situation is not addressed quickly, the US banking system could face a perfect storm where the liquidity shortage leads to a widespread financial crisis. This happens because, without sufficient liquidity, banks begin to increase interest rates, making credit more expensive or even restricting access to credit altogether. Impact on the real estate market. One of the sectors most impacted by this liquidity crisis will be the real estate market. The lack of available credit directly affects people's ability to finance properties. Purchasing a home is one of the largest investments most families make, and much of these purchases are financed through mortgage loans. Without access to financing, many people will no longer be able to buy homes, which could lead to a drop in property prices. Additionally, with fewer buyers in the market, the construction of new homes and real estate trading may collapse, which negatively impacts the construction sector, which employs millions of people in the United States. This would result in job losses and further affect consumer confidence, which may already be shaken due to rising interest rates and credit shortages. Signs of crisis in smaller banks. The signs of an imminent banking crisis are already visible. Smaller banks, which depend more directly on credit for their operations, have already begun showing signs of difficulties. Bankruptcies of some smaller financial institutions have started to happen in states with declining real estate markets, like California, and the personal credit market has been one of the first to be affected. If this continues, it could result in a series of bank failures that would trigger a wave of panic in financial markets. When a bank fails, it can trigger a domino effect, causing other financial institutions to experience difficulties. Larger banks, although more resilient, are also facing challenges, as when a significant number of institutions begin to fail, investors lose confidence in the entire banking system. This can cause a capital flight and an increase in withdrawals, further exacerbating the liquidity crisis. The role of the government and regulators. In such a scenario, the government and financial regulators have a critical role to play. The Federal Reserve can intervene in several ways to stabilize the situation, including increasing liquidity injections into the banking system and implementing lower interest rates. However, these measures come with side effects, such as the risk of generating inflation or creating economic bubbles in sectors like the stock market and real estate. Additionally, the government might be forced to guarantee deposits for individuals and businesses, as it did during previous crises, to prevent the complete collapse of the banking system. This intervention could be vital in restoring public confidence, but it could also lead to significant fiscal repercussions, such as the increase in public debt. What to expect for the future? The immediate future of the United States largely depends on how the banking system will handle this liquidity crisis. If the lack of reserves continues, the country could head into a deep recession, which would primarily affect middle and low-income families who are already facing high living costs and elevated unemployment rates. If the government and regulators are effective in their response, it may be possible to avoid the complete collapse of the banking system, but the road ahead will be challenging. The US economy, as well as global economies, may go through a tough adjustment period with high unemployment and credit restrictions that hinder economic recovery. So in short, we are facing an imminent threat to the financial system, and the actions taken in the coming months may determine the depth of the crisis. The lack of bank reserves is a clear sign that tough times are ahead, and everyone needs to be aware of the impact this situation will have on personal finances and the market as a whole. When we talk about an imminent banking crisis, like the one that may be unfolding in the United States, one of the central concepts that needs to be understood is bank reserves. But what exactly are these reserves, and why are they so crucial to the functioning of the economy? Let us explore the fundamental role that reserves play in the banking system and how their scarcity can trigger a series of economic repercussions. What are bank reserves? Bank reserves are the funds that banks hold in deposits at the central bank, such as the Federal Reserve, Fed, in the United States. They act as a sort of insurance to ensure that banks can operate without interruptions, making sure they have enough liquidity to meet any payment or withdrawal demands from customers. Reserves can be held in the form of physical cash or as electronic deposits at the central bank. These reserves don't just sit idle, they help the central bank regulate the amount of money in circulation within the economy. For instance, if the central bank wants to increase the money supply in the economy, it may allow commercial banks to hold fewer reserves, thus freeing up more money to be lent and circulated. In contrast, if the central bank wants to reduce inflation, it can require banks to hold more reserves, thus restricting available credit. The role of reserves in the banking system. The primary function of bank reserves is to provide liquidity to banks. Liquidity, in simple terms, is a bank's ability to have enough money available to meet its customers' demands. For example, if a large number of customers decide to withdraw their money from the bank at the same time, as may happen in a financial crisis, the bank needs to have reserves in place to meet those withdrawals. In addition, reserves are critical for the process of credit creation. Commercial banks do not keep all the money they receive in deposits. Instead, they lend out most of these funds to individuals and businesses. This process generates credit expansion, which drives the economy forward. In other words, banks lend more than they hold, which increases the money supply and fuels economic growth. How reserves affect the economy. Bank reserves directly influence the credit market and consequently the behavior of consumers and businesses. When banks have sufficient reserves, they can lend money at lower interest rates, making credit more affordable for purchasing durable goods such as homes and cars, or financing new business projects. However, when bank reserves fall, as is happening currently in the United States, the banking system has less ability to lend money. This results in higher interest rates as banks attempt to balance the scarcity of resources. With higher rates, credit becomes more expensive and harder to obtain. This directly impacts consumers, who may postpone purchasing a home, and businesses, which may delay or cancel investments, ultimately slowing economic growth. Additionally, the credit shortage can lead to a decline in consumer confidence and economic expectations. If consumers can't access credit easily, they tend to cut back on spending, reducing demand for goods and services, which in turn can lead to an economic slowdown. What happens when reserves are insufficient? When bank reserves fall below a safe level, the economy begins to experience liquidity problems. This is one of the primary signs of an impending banking crisis. Without sufficient reserves, banks struggle to meet their financial obligations and begin to restrict credit even further. This not only affects consumers who need loans, but also businesses that rely on financing to grow and expand. The shortage of credit affects primarily the consumer and real estate markets. When people can no longer finance the purchase of a home or car, demand for properties falls, which could lead to a decline in property prices. This creates a recession in the real estate market, which also harms the construction sector, a cornerstone of the economy. Without access to credit, businesses may also be unable to finance new projects, reducing investment rates and negatively impacting job creation. When a banking crisis begins to unfold, its ripple effects extend far beyond the financial sector. The consequences of a banking collapse can significantly disrupt the real economy, impacting everything from consumer behavior to business investments. Understanding how a banking collapse influences the broader economy is key to grasping the full scope of the crisis. The link between bank reserves and the real economy. As we discussed earlier, bank reserves are crucial for ensuring that banks have enough liquidity to meet their obligations and continue lending. When reserves are low, banks become hesitant to lend, and interest rates rise, making borrowing more expensive. For individuals, this means that purchasing power is restricted. Homes, cars, and even education become harder to finance. For businesses, the situation is even worse, as the lack of credit affects expansion plans, hiring, and day-to-day operations. A liquidity crisis resulting from inadequate reserves affects economic growth by dampening demand. With fewer loans available, consumer spending declines because people can't afford to buy homes or goods on credit. This reduces overall demand for goods and services, leading to a contraction in the economy. The impact on the housing market. The housing market is often one of the first sectors to feel the pain during a banking collapse. With limited access to credit, fewer people can afford to buy homes. This reduces the demand for properties, causing house prices to fall. For homeowners, this is problematic because it reduces the value of their properties, potentially leaving them with homes worth less than their mortgage debt, a situation known as being underwater. As home prices decline, the construction industry also suffers. Developers stop building new homes because of the reduced demand, and construction workers lose jobs. This domino effect negatively impacts the broader economy, as housing is a major sector that supports jobs and investment. The impact on businesses. In a banking collapse, businesses face difficulties obtaining the necessary capital to operate and grow. Many businesses rely on business loans to fund their operations, whether it's for hiring staff, buying equipment, or expanding their infrastructure. When credit becomes scarce, businesses are forced to scale back their operations, lay off workers, or delay expansion plans. The reduction in business activity leads to a decrease in overall economic production. Companies that cannot access credit may also struggle to pay off their existing debts, leading to an increase in business bankruptcies. This, in turn, contributes to higher unemployment rates, further limiting consumer spending and creating a vicious cycle of economic contraction. Social impacts of a banking collapse. Beyond the financial and business impacts, a banking collapse also has social repercussions. Unemployment rises, wages stagnate, and poverty rates increase as people lose their jobs or see their incomes decline. The middle class, which is often heavily reliant on credit to support their lifestyle, is particularly vulnerable in times of financial crises. A reduction in consumer confidence further exacerbates the situation. As people become more uncertain about their financial future, they cut back on spending, contributing to a recessionary spiral. This can lead to more social unrest as communities struggle to cope with rising unemployment and a shrinking economy. The global impact of a US banking collapse. Because the US economy is so deeply intertwined with global markets, a banking collapse in the United States would have far-reaching consequences. Many foreign banks and investors hold US debt and are dependent on the stability of the US financial system. A collapse in the US banking sector could result in a global credit crunch, as international banks may be reluctant to lend to US institutions or to each other. In addition, foreign markets could see their own economic growth slow down as a result of the turmoil in the US. Countries that rely heavily on trade with the US may experience a decline in exports as US consumers pull back on purchases. This ripple effect can create a global recession, as the interconnectedness of the world's economies makes it difficult for any nation to remain isolated from the effects of a major financial crisis. The consequences of a banking collapse are not confined to national borders. Given the global interconnectedness of financial markets, a crisis in one country, particularly the United States, can quickly spread and create financial instability worldwide. In this chapter, we will explore how a banking collapse in the US could trigger a global financial crisis, with far-reaching impacts on economies, markets, and individuals around the world. Global financial interdependence. In today's interconnected world, the US dollar is the world's primary reserve currency, and US financial markets play a central role in global trade. The US banking system is integral to the smooth functioning of the global economy, facilitating international trade, investment, and the flow of capital. When the US banking system faces a collapse, it has immediate spillover effects on other markets and economies. For instance, many foreign countries hold significant amounts of US Treasury bonds as part of their foreign exchange reserves. If the value of the US dollar were to plummet during a financial collapse, these countries would experience losses in their reserves. This could lead to a ripple effect of devaluation in other currencies, creating financial instability in global markets. The impact on global trade. A banking collapse in the US would severely disrupt global trade. As US banks tighten lending or fail entirely, companies around the world would find it harder to secure financing for international transactions. This would slow down global supply chains, reducing the movement of goods and services across borders. Countries that depend heavily on exports to the US, such as China, Mexico, and many European Union countries, would be directly affected by a drop in demand for their products. This decrease in global trade would negatively impact their economies, leading to lower GDP growth, higher unemployment, and reduced investment. Impact on emerging markets. Emerging markets, which rely on foreign capital and investment from developed countries like the US, would feel the effects of a banking collapse even more acutely. A US financial crisis would lead to a reduction in capital flows to emerging economies, which could push many of these countries into financial turmoil. As US banks fail and capital becomes scarcer, interest rates rise, and foreign investors become more risk-averse, pulling their investments from emerging markets. This capital outflow could lead to currency devaluations in many developing economies, increasing inflation and making it more expensive for them to pay off their debts, much of which is denominated in US dollars. These countries would struggle to maintain economic stability, and some could even face sovereign debt crises as a result. Global recession and unemployment. As the banking collapse in the US creates a global slowdown, economies worldwide would be at risk of entering a recession. Unemployment would rise as businesses across the world scale back operations due to the lack of credit and reduced demand for goods and services. The ripple effect of this job loss would result in a decline in consumer spending globally, further deepening the economic crisis. For many countries, the loss of jobs would be devastating, especially in economies that are already struggling with high levels of income inequality and poverty. This could lead to social unrest, with protests and political instability increasing as people demand solutions to the crisis. The future of the US economy is at a critical juncture, especially given the current banking system challenges. As we have explored in previous chapters, the decline in bank reserves, a key signal of a potential banking collapse, can create widespread consequences for consumers, businesses, and global markets. The question now is, what does the future hold? How will the US economy navigate through these turbulent times, and what steps can be taken to mitigate the fallout? The immediate threat? A looming recession? At the forefront of concerns is the possibility of a recession. As bank reserves decline, access to credit becomes increasingly difficult, and borrowing costs rise. The recessionary spiral is not just theoretical, it is a very real possibility. With higher interest rates and tighter credit, businesses and consumers will have less money to spend. This will lead to reduced economic activity, lower consumer demand, and potentially a sharp contraction in GDP. The housing market is one of the first sectors to show signs of stress. As credit becomes scarcer, fewer people will be able to purchase homes, leading to a decline in property values. This could result in homeowners owing more than their properties are worth, potentially leaving them with underwater mortgages. Additionally, the construction industry would likely take a hit, as fewer homes are built and fewer workers are needed, leading to job losses. The potential for government intervention. In the face of such a bleak outlook, many are wondering whether the government will step in to stabilize the situation. The Federal Reserve and other regulatory bodies play a crucial role in mitigating the impact of a banking crisis. In response to the banking collapse, the Fed may intervene by injecting liquidity into the banking system, essentially providing banks with more reserves to prevent further bank failures. The government might also consider bailouts for struggling financial institutions, similar to the measures taken during the 2008 financial crisis. While such interventions can stabilize the financial system in the short term, they come with risks. Bailouts can create moral hazard, where banks take excessive risks because they expect government assistance in times of trouble. Furthermore, these measures can be highly controversial and may strain the government's budget, leading to an increase in national debt. What happens if the crisis is not contained? If the banking collapse is not contained, the consequences could be severe. A prolonged banking crisis could lead to widespread unemployment, especially in sectors reliant on credit, such as real estate, construction, and manufacturing. Small businesses, which often rely on loans for operations, would be particularly vulnerable, potentially leading to business closures and significant job losses. A global recession could also follow. As we have seen, the US is deeply intertwined with the global economy, and a crisis in the US banking system would likely lead to fallout in global financial markets. Foreign investors might pull capital out of US markets, and global trade could slow as countries face difficulties accessing credit. Emerging markets could suffer the most as they rely on investments and loans from developed countries like the US. The long-term effects of such a crisis would likely include weaker economic growth, higher inequality, and increased political instability. In the worst-case scenario, the US could face a prolonged period of economic stagnation, similar to Japan's lost decades in the 1990s, when its economy struggled to recover from a banking crisis. Strategies for recovery. Can the US bounce back? If the US is to recover from this looming crisis, bold actions will be needed. Restoring confidence in the financial system is the first step. The government and regulators must ensure that banks are stable and have sufficient reserves to meet their obligations. This could involve expanding deposit insurance, as well as providing emergency liquidity to struggling banks. In addition, addressing the underlying causes of the banking collapse will be essential. This may include rethinking banking regulations to prevent excessive risk-taking and ensuring that banks have adequate capital reserves to weather future crises. The financial sector needs to become more resilient to prevent future collapses and provide a more stable foundation for the economy. Furthermore, the US government must focus on stimulating economic growth. This could involve fiscal stimulus packages, which would inject money into the economy through public spending on infrastructure, healthcare, and other sectors. Lowering interest rates could also help stimulate borrowing and investment, although it may not be as effective in a low liquidity environment. The role of the American people. While government actions are vital, the American public also has a role to play in the recovery process. Consumers, businesses, and investors will need to adapt to the new economic environment. Consumers should be prepared for higher costs and potential job losses, while businesses may need to restructure to survive in a tighter credit market. Investors should stay informed about the state of the banking system and be cautious with their investments during times of uncertainty. In the long run, a shift in economic priorities might be necessary. The US may need to focus more on fostering sustainable growth and financial stability rather than unchecked expansion. This could involve investing in innovation, infrastructure, and workforce development to ensure that the country is prepared for future challenges. Conclusion: navigating through troubled waters. The future of the US economy is uncertain, and the path ahead will not be easy. The country faces significant challenges as it grapples with the effects of a banking collapse and the possibility of a global recession. However, with the right interventions from the government, careful planning, and strategic reforms, it is possible to navigate through this crisis and emerge stronger in the long term. The road to recovery will be challenging, but the resilience of the American economy, along with global cooperation, will be essential in overcoming this crisis. It is up to policymakers, businesses, and the public to work together to rebuild trust, stabilize the financial system, and lay the groundwork for future economic prosperity. What do you think about the current state of the US banking system? Do you believe the government will step in to prevent a crisis, or is it too late? Share your thoughts and comments below. Let's discuss how this potential crisis might affect you, your business, and the global economy.